What's going on, guys? Welcome back to the page. Today we're going to be looking at the indices as well as tickers within the actual indices. We're going to look at the value line geometric index as well as indicators that can help us know whether we're going to be going to the upside or even to the downside. Also look at some yield curve as well as look at Bitcoin, crude oil futures, as well as some important earnings that are going to be coming up and how they could possibly affect our trades as well as our investments. Not only that, but some other economic data that's going to be very important to pay attention to. But before we get into any of that, I also want to point out some important data that came out this week, such as the CPI data. So if we look at this, it's important to know that CPI data is a month behind. So this July release was for the month of June because they take all the numbers from the month of June from start to finish, average them all out, do the calculations and create the charts and everything and release it for the month in July. So for the month over month from May to June was 1.3% increase on CPI data. It was 9.1% increase on for the month of June year over year, and for core inflation or core CPI over the 12 months in the month of June, it was 5.9, meaning that the Fed has been doing their job as core CPI has been going down, but they don't control the supply constraints that have been going on because of Ukraine, Russia, as well as some of the stuff that we're still experiencing because of COVID. So we've definitely seen some increases on other components, specifically energy and food, that have been basically increasing over and over and over again, month over month, year over year for each month. That is two. And there's important things that I want to highlight. One in specific, I mean, obviously we know food and energy are higher than average, typical. That's everything you hear in the news. But one thing to point out is shelter. Shelter you see is been increasing 0.5, 0.5, 0.5, 0.6, 0.6. You know, if we continue to get increases like this, that actually be pretty damn ridiculous, guys, because shelter is a sticky component of CPI data, meaning that it doesn't increase as rapidly as other components or it doesn't decrease as rapidly as other components. So if we're continuing to see this type of upside, and ultimately if the market does slow down, we see prices do come down, they're not going to go down as fast as other component. We won't necessarily see the downside that we want to be able to see. It's also important to note the earnings that have happened so far, so such as like JP Morgan on Thursday reported bad earnings. However, Citigroup reported good earnings. So it's important to note that just because there's mixed results on how companies have been performing so far and as well as their outlook as well. Really tell and really notice that on the XLF sector, but more specifically the SPY in general, as the XLF is part of the SPY. We saw a lower low on Thursday versus the QQ actually saw equal low or even a higher low from Wednesday to Thursday. So SPY, we see this, we could be putting in triple top, possibly a lower low each time. So if we were to draw a trend line from the peaks, possibly hitting this 390, 390-ish level as resistance, putting in a triple top or possibly a slightly lower lows each time. And if we were to do it from the bodies to the bodies, once again, we could be hitting this as resistance. Not only that, but there's a small gap on the smaller time frames that we could hit as resistance to the upside as well. That's also in confluence with the bodies if we were to draw a trend line from basically this high, and then possibly the next high to come. We got this 381-ish level as well as this gap. And if you want to see these values, you can look at them as for potential areas to bounce. But if we were to break through them with substantial volume, then we could even possibly see the lower lows, possibly something like this 374-ish level, but more specifically this 370 level in the future. So be mindful of that, guys. Again, if we look at the before we go to the smart time, let's go and look at some indicators. So we look at the standard deviation channel. It's not really giving us anything, even if this was this 2 and this -2 were moved to the -1 as well as the +1. It doesn't really tell us really information. Considering the fact that basically we're in the neutral territory. Maybe a possible 393-ish level, which you could see more if I was to put this, possibly be a possible area we could bounce to. However, that's really far out of range, but really anything's possible in this type of market, in this type of economy. If we look at the anchor VWAP deviations, which is another indicator I like to look at, we're kind of in no man's land. We fell down to it, bounced off of it as support, and ultimately launched to the upside on Friday. However, once again, we're in no man's land, so something to be mindful of. And the last thing, or another thing I want to look at, two things actually, is one, the Bollinger Bands. If we look at the Bollinger Bands, it's tightening like crazy ever since the 24th. However, because of Friday's data point, it showed a slight uptick on the Bollinger Bands, supporting that we possibly could see some moves to the upside, that even though there was a contraction, now we're seeing a slight expansion. But that doesn't mean that we can't go to the downside either. So be mindful of that, guys. And plus the overall trend is down, so it's kind of hard to fight the trend. If we look at the RSI, however, we can see two important things. One, on the larger time frame, we see that we're hitting up against resistance. We still haven't broken it as we've been continually contracting. But not only that, but if we look on the smaller time frame, Let me go and zoom. Oop, not zoom in on that. Oh my gosh. If we zoom in here, we can see again we have that gap to the downside we could possibly see. But more importantly, the thing that I want to focus on is this slight divergence, this negative divergence that we got going on here. As you could see, we have a higher high in the price action. However, we got a lower low on the oscillator, which is the RSI, which we're looking at, which is a negative divergence, which again supporting the idea that we could possibly see a pullback on Monday, either a gap down or even the price action itself going to the downside. Same thing with the QQ, basically the same thing, possibly see a triple top, the upside, the area to watch for resistance is this 397-ish level all the way up to the 300 level as its psychological level. And also there's this gap that has yet to be filled from the last CPI data reading. So that's something to watch for. We've been creating higher lows, letting us know that we are having more strength in the SPY itself. However, if you were to remove all these trend lines, it looks like a bearish pennant. As you see, like we keep that 397-ish level there holding, we have this little come up here, and we fix this to be like that. It looks like a bearish pennant, and we could be ultimately just break to the downside, but we want to watch the break of this actual trend line itself before actually just guessing or anticipating that's actually going to happen. So again, watch that 397 to 300 level as possible area of resistance, but also area for support could be this 286-ish level. But if we were to fall further, probably about this 284, 285-ish level, possibly see as a possible area to bounce from, as well as we've bounced here, as well as here. Excuse me. And even on the smaller time frame, on this one, we do have a slight divergence as well. We saw higher highs on there, but on the oscillator itself, we saw lower lows. Out that divergence that we see there. But if we go back to the daily time frame, actually the one deviation is telling us a little bit of something, not too much, but it's giving us more of an area to watch for resistance than the actual SPY as itself. As you see, the area to watch for would be about 293-ish level for resistance if we were to go to the upside, as that would be the first deviation. Moving on, if we look at the actual indices within the QQ, as well as the indices, the components of the QQ and the components of the SPY, we can see Apple, Microsoft, Amazon, Tesla, and Google are the main 5 holdings. So what are their charts looking like? Currently, Apple is hitting this resistance level, the 150. It's a psychological level for one. And two, it's been a major area of support and resistance. As in the past, we consolidated in this area from basically July all the way up until November of 2021, hitting this multiple times, chopping around it, false breaks to the upside, ultimately selling out to the downside. That's really strong resistance there, support there, resistance here, and we're currently facing it once again as resistance. So this could be a double top that we could see there. Not only that, but Microsoft is also showing weakness as we're hitting this trend line. We wicked up to it, but ultimately sold off from that level. We actually had bad news on Wednesday, so this stock is, was it Wednesday or Tuesday? I don't remember if it was Tuesday or Wednesday. But anyways, we ultimately have weakness compared to the rest of the other components of the QQ and the SPY. Amazon also in this wedge pattern, tightening, consolidating. Could be a bearish pennant because the overall trend is down. Ultimately going to break to the downside. This 102 area would be to watch because it's served as support many times. Not only that, but in the past it's acted as resistance as well. So it's a major area to watch as it's basically held a lot of times throughout history. Tesla, also something to watch. Possibly another bearish pennant. Possibly could be heading to the downside, guys. Google, a weak stock overall throughout the week compared to the rest of the actual tickers, the main holdings within the SPY and the QQ. Also has a stock split on Monday. And we know how Amazon ended up playing out. If we look at it, actually, let's go and look at it right now. On their stock split date, we ultimately sold off like crazy. There was a run up, and the same thing with Google. There was a run up, but ultimately the week before there was a weakness. Not only that, but the actual day itself normally isn't really that good of a day, or the week after that or 2 weeks after that, it's not really that much of a bullish sign anymore. It's the hype for the stock split, not the actual split itself, which all that comes for. So again, the overall indices have potential to head to the upside. They're currently at resistance levels or potential areas which could act as resistance. Not only that, but the actual components of the indices themselves are acting as resistance. And we can see the value line geometric index is has a sharper decline than the actual SPY has itself, letting us know that the main tickers within the SPY, the more heavy weighted ones, the technology stocks, are the ones that are keeping the market up at the moment. So with these slight lower lows, as well as these basically leveled bottoms, we're seeing more strength in that value line geometric index, basically letting us know, once again, the tech stocks are the ones that are holding up, not the actual market itself. So if we also look at the VIX, multiple times whenever we hit this area right here, we saw selling off as the VIX gained more energy in the volatility wise. However, we've seen breaking of this level. A possible area to watch as support is the 235.55-ish area, as it acted as resistance in the past. Here in these different levels in which it either wicked to or ultimately wicked above, but ultimately broke close below. And not only that, if we break that, then ultimately this roughly about this 2150, 21 to 2150-ish level could be possible support. So that's something to watch out for the future. As for the put to call ratio, this is the weekly time frame, and as you see multiple times, whenever it hits this trend line, when it's heading to the downside, which means people are overly bullish, we've ended up sold off here. This area it failed. It actually continued to rally to the upside, but here sold off, here sold off, here there's a slight more gain, but ultimately sold off. Sell off right here, but there's not so much of a convincing move as like this or even like this. There's not that much of a sell off to the downside, so there possibly could be more, as we possibly could hit it once again. However, it's anyone's game at this point when it comes to that. As for yield curve inversions, I mean, as you can see, we've been inverted ever since, July 5th, and we're or July 5th or June 5th? Yeah, it's July 5th. And we want to see a hard inversion if we're wanting to use this as a recession indicator. And basically a hard inversion is basically when it's been under the zero line for a substantial amount of time, like about a month or so. And currently we're heading on, what is that? Roughly 10 days, slightly more. So be mindful of that, guys. Each one of these readings that when we shot to the downside, it was after CPI data readings. So it just shows you how bad CPI has been compared to what the market's actually pricing in. 3-month and the 10-year. I wanted to see these marked up against each other because, again, the 2-year, 10-year is a good signal. However, the 3-month and 10-year is even better signal, letting us know it was coming up here in the near term. And we've been selling off like crazy. Once again, at the end of the CPI data readings, we've seen a massive drop. Ultimately, could we see a more massive drop, potentially leading us to inversion? Possibly. We need to look for that in the future and be mindful of this as an indicator for a possible recession. Also, the Bitcoin hasn't really been doing the best. Each time we've seen some type of potential strength or potential uptrend, potential channel, it's sold off, guys, time and time again. So saying that this time is different, we need to have some fundamental reason of why we want to believe it's different. Fundamentally, there's nothing changed about the markets. The Fed's still tightening. Earnings reports are coming up, which could potentially show weakness within the markets. We're seeing worse CPI data, letting us know that inflation hasn't peaked out. We're also seeing job reports as well as PPI, retail sales. We're seeing all this data better than expected, letting us know the market's continuing to propel forward, which is good for the economy. But the Fed sees a healthy economy. It's going to continue to tighten, knowing that it has the opportunity to be able to tighten continuously. Not only that, but on this move to the upside, we're seeing this massive decrease in volume. So this first day to the move to the upside, that was a good move. However, every time after that, been a decline, and we don't want to see that. There's usually more volume during the week, so maybe what's called over the weekend, we might not see that much volume unless we're seeing a huge move to the upside or a huge move to the downside. But there are some names within crypto that have been showing some strength, such as Ethereum, as well as Matic. See, for example, Ethereum actually created a higher high out of all these. And not only that, but Matic itself has shot up pretty well as well. Matic actually had some news that came out. I believe it was this day on the 13th or one of these 2 days. It had news that came out that propelled it forward. Not only that, but it also linked to Ethereum. So that's why it's seeing a nicer valuation than other cryptos such as Solana or XLM or even XRP. You know, all these other names are weaker and weaker than these other two. Another thing to pay attention to is crude oil futures. As you saw, we had this longer term trend line that was holding up, but ultimately we saw a breakdown, a retest, but ultimately break to the downside. We've created this new type of channel as we had 1, 2, 3, 4 touches. And we also had a 1, 2, 3, 4 touches on the downside. So we could continue this, and if we were to see a break to the upside or a break to the downside, it'd be nice to be able to see. But if not, we're just gonna continue this trend, lower lows and lower highs. And this is good for gasoline prices, but it's kind of bad for the economy in general, just because they're kind of pricing in a recession that is to come. However, one thing that could not necessarily contradict this, but could break this trend and send gas prices up to the upside, oil prices to the upside, as well as gasoline prices to the upside, is the whole energy crisis that might be coming up in the future in Europe. Right now, the summertime, they don't need heating, but European countries rely heavily on gas for heating during the winter months as well as the fall. So just know that that's something that we possibly could be facing here in the near future. Some of the last things I want to talk about is the news coming out. As you can see, there are a few more bank names that are to come out financials, but there are some tech names that are coming out as well, such as Netflix and Tesla. And not saying that this week isn't important, as every other earnings week is important, especially these first two. But the third week of July, or not the third week of July, but in 2 weeks, basically is something that we want to really pay attention to, as Microsoft, Alphabet, Meta, Apple, Amazon, ExxonMobil, Chevron, and Phillips 66 are reporting, and these are big hitters within technology and the biggest hitters within the actual energy sector itself. So that's something really important to pay attention to, guys, as we head into this earnings season, because they're the ones that are the most influential in the markets, letting us know the potential forecast for our gas and our oil. Not only that, but the potential forecast for technology stocks, as well as just the SPY and QQ in general, just because they are the main components. And there's also one last thing I did not pull up, but I do want to show. I do want to point out something very important. So on a 1 month relative basis, we're basically showing that energy has been weak, very weak. And even on the 3 month relative basis, we see that energy is one of the lagging sectors. And that's showing us that energy has finally hit a weakness point, letting us know that basically its reign, or where we are at in the market cycle, is no longer energy focused. So we could be somewhere between the midpoint and a late bear market, somewhere in this middle phase, as healthcare, utilities, and consumer staples are the main performers. As you can see, healthcare, consumer defensive, which is consumer staples, utilities. These are the main performers. So we're somewhere in between these two phases, a bear market and a late bear market, based off of this whole sector rotation theory. So it's something to keep in mind, as we could be already hitting our market cycle, our economic cycle top, and now heading into the down cycle. So the markets precede the economy, but the economy is what drives the markets. It's always something important to keep mind of. But that's all I got for you today, guys. Hopefully I did enjoy this, get something out of it.